What day is the best day of the week for you? For me, Saturday is the best day. But for most Americans, payday is the most wonderful day of the week. Presently, one of the main reasons why so many Americans are living from paycheck to paycheck is because so many individuals make major mistakes when that special day rolls around. I know you're not perfect, and so am I. But did you know that there are actually effective ways to save and invest your money during payday? Hey everyone, this is Capital Finance, your go-to channel for business ideas, entrepreneurship, investment, and personal finance. In this video, let's take a look at how you can save and invest your money as soon as you get paid. Now, before everything, make sure to give this video a like, and let's start. I'll be the first to acknowledge that getting paid is one of the best feelings in the world, but sadly, a lot of people just don't know what to do with their money when they have it. Without a strategy, you'll almost certainly end up spending your money on unnecessary products, and proper spending might be difficult even with a set budget. Over the last year, Americans have admitted to spending an average of $8,000 in excess of their budget. In fact, according to the findings, just 75% of Americans claim they have a budget, and of those, 80% still have difficulties staying within their own limits despite their best effort. It's heartbreaking to see that even those who properly prepare their budgets wind up spending $150 more than they intended each week. In all, the average weekly budget of those surveyed is $200. However, it turns out that amount is ambitious at the very least. In actuality, the average weekly household expenditure in the United States is closer to $350, which explains why just 11% of those polled said that keeping to a budget was simple. The fact that Americans overspend every month is one problem, but another is what they spend it on. Eating out, purchasing beverages, and getting takeout are the top 3 non-essential costs preventing Americans from saving money. To improve your financial well-being, you need a strategy that you can apply as soon as your paycheck arrives so that you don't end up exceeding or overspending your money. Because many individuals either don't have a budget in place or don't find the one they use useful. I'd want to start fresh when outlining exactly how you should distribute your money when you are paid. If you're new to the percentage approach, I propose that you utilize it as a starting point for allocating your money among your many financial obligations. You may think of it as a breakdown of how your monthly money should be allocated. The percentage approach is broken down into 4 areas: putting money aside, having flexible spending, having set costs, and having a roof over your head are all essential aspects of responsible financial management. Given that housing accounts for the majority of the average person's overall monthly expenditures, it is often a non-volatile expense. Having its own category in the model is something I think is a good idea. This money management tool requires you to know how much each of the 4 categories should cost you in order to utilize it effectively. Number 1. So let's begin by putting some money aside. It is a good rule of thumb to save at least 6 months to 1 year's worth of living costs in an emergency fund before putting any money into a savings or investing account. Notwithstanding the modest percentage of your revenue allocated to this area, it is by far the most critical. In the other 3 areas, you must spend money on things that will keep you going on a day-to-day basis. Savings, on the other hand, can help you improve your financial status by lowering your interest payments or by increasing the amount of money you have invested in your portfolio. Number 2. Next is your flexible spending, which might include everything from meals and beverages to petrol and apparel. This is the category that accounts for many of the unnecessary purchases made by Americans, as I've already said. When it comes to this area of expenditure, it is vital that you adhere to the budget you've established for yourself each month. Number 3. Set costs, such as your vehicle payment, utility bill, and life insurance, make up the third area. To be clear, these are costs that don't fluctuate significantly month to month, which makes it easier to keep track of how much money you're spending on them. Number 4. Housing is the last of these percentage areas. Most people's rent or mortgage payment is a six-penny item that is easy to mismanage, but the mistake really occurs before you spend a single dollar on this sort of expenditure. It's common to see people take on more debt than they can manage in order to purchase a more expensive or larger apartment or property. Once you understand the percentage approach, you need to know how much of your post-tax income you should allocate to each of the 4 categories every month. In my opinion, the best model is as follows. Savings should take up 15% of the budget, with 30% going to varying costs, 30% going to fixed expenditures, and 25% going to housing. Depending on your long-term financial objectives, these percentages may change, but for those just starting out, these percentages will definitely work. Using the percentage approach is a solid way to ensure that you make progress toward your financial objectives each and every month. I say this based on my own personal observations. Nevertheless, it does need a lot of time and work. It was only after utilizing the percentage approach for some time that I figured out how to modify the system to make it as hands-off as feasible for myself. Here are 3 methods I use to make my money management strategy seem simple. First step, open the appropriate accounts. In order to simplify and automate your financial management process, you must first sign up for the appropriate accounts. A single checking or savings account is what the majority of people would use with this arrangement, but this only adds to how much time and effort it will take each month to make it work. Aside from checking and savings accounts, you'll need an emergency fund, a debt payback account, and an investment account to satisfy all of your financial needs. Second step, utilize automatic deductions. 75% of American employees receive their paychecks by direct deposit. So if you're among them, you may benefit from the convenience of automatic deductions. Automatic deductions from my paycheck at work were one of the finest decisions I've ever made in terms of managing my finances. In effect, these deductions allow me to divide my income into many accounts and transfer the appropriate amounts to each one. When I first set up this method, I assigned 5% of my after-tax income to my savings account, 5% to my investment account, and 5% to my emergency fund. Now that they've generated additional money and have fully funded my emergency fund, I've decided to split that 15% between my savings and investment account. In the long run, you'll recognize that you'll need to distribute your income in a way that makes the most sense for you and your financial situation over time. Third step, utilize automatic bills payment. Trying to remember to pay your bills on time simply adds to the frustration. It's important to make sure that your monthly bills are paid on time by automating the process. Automated bill and credit card payments can now be set up in 2 ways. If you have a checking or savings account, you may set up automatic withdrawals from the amount of your bills. With only a few phone calls to your service providers, you'll be able to initiate withdrawals from any of these 2 accounts. Option 2 is to create a bank account only for the purpose of making payments on invoices. This strategy has both advantages and disadvantages. This method has the advantage of making it easy to evaluate the bill amounts because the account has been specifically set up for this sort of spending. However, if you end yourself in an overdraft, you'll have to pay banking costs. To put it another way, your bank will cover the withdrawal amount if you don't have enough money in that account and then charge you for doing so. Even if this is unlikely to occur if you use a bill payment account instead of your savings account, it doesn't imply you should disregard the option. Put in 1 to 2 times your monthly expenses when you initially start a bill payment account, and also make sure that you have a regular payroll deduction to cover the continuous withdrawals over time. With all this taken into mind, using the percentage approach is much simpler after you've completed these 3 steps. So, what are you waiting for? Start your saving and investing journey now. That's it for this video, folks. If you like this video, make sure to subscribe to this channel and click the notification bell for more content like this. See you next time!